Let's get more reaction to the jobs report and what it could mean for the Fed's next move. Joining us now is Judy Shelton, a senior fellow at the Independent Institute and the author of Money Meltdown. Judy's latest piece for the Journal, Wall Street Journal, is called "The Federal Reserve at War" and explores the central bank's response to global turmoil. Another uncertain data point to throw into to the Fed's calculus on what it's going to do, Judy, which you point out kind of by the seat of the pants at times, meeting to meeting, because no one has a crystal ball, and theirs doesn't seem to be much better than ours. What can we learn from history and wars? They're inflationary, aren't they? And the Fed, I think, feels they don't want to be, with a couple of wars going on, they don't want to be the problem. So they're usually pretty accommodative, which just makes it worse for inflation.
Well, that's right. And, you know, the narrative has gotten a little bit stale about whether the Fed is going to raise 25 basis points this year or next year or never. And that's why in that piece for the Journal, I wanted to point out that the changes in the way the Federal Reserve impacts financial markets and economic performance, the ones that have a dramatic impact are the ones that you don't see coming. It's really when the Fed does have to respond to shocks. There's an interesting research study that's posted on the St. Louis Federal Reserve website, and it talks about the Fed responding to major wars going back to the Civil War, and it even compares the federal government's response and the central bank's response to COVID in terms of responding to a war, because it was a war on COVID. And what always happens, as you said, there's a sharp increase in government spending, there's substantial monetary accommodation of that, and that results in inflation. Inflation has been associated with every major war the United States has experienced. But that becomes a secondary concern. The big concern is that, for instance, under COVID, in March of 2020, you would think that everyone would pile into treasuries and the rate would come down as a safe haven asset. No, they started dumping treasuries, especially Saudi Arabia and the United Arab Emirates and China. And what they really wanted was cash. That was the ultimate safe haven. So the Fed suddenly, within a week, saw a 64 basis point difference in yields and ended up, for the first quarter of 2020, having to buy $1 trillion in Treasury securities. And that was more than it had to buy in any of the QE1, QE2, or QE3. And so those are the things that really impact monetary policy going forward, because when the Fed has to do these gigantic things, the real trade craft, I think, in monetary policy is how quickly can you go back to normalizing. And that seems to be the difficult part for the Fed.
That just adds, just another variable to try. We had enough. I mean, we already didn't have any idea about the future, Judy, and now this just makes it more intractable. What about the numbers that we just saw? Do you think the Fed at this point can declare a quasi-victory in terms of inflation and they don't need to raise anymore? That's kind of what the perception. And then you heard, I don't know if you heard Rick, but the interest costs are going to go up once all these things are factored in. And I don't know if we can just go to bed and say we're going to be at 4.5 on the 10-year forever. I mean, a year from now, I wouldn't even venture a guess.
Well, the Fed would, I think, much rather not have to keep raising. I thought it was really interesting at the press conference when Chair Powell said that the members of the FOMC found it very gratifying that they've been able to raise interest rates by 500 basis points without it seeming to curtail growth or cause higher unemployment. I think the real word should be bewildering. They don't know why. They thought it would be painful. So for me, what the Fed should be paying more attention to is the impact of fiscal policy. The Fed is running this contractionary monetary policy, while from a fiscal point of view, it's classic Keynesian stimulus. It's massive deficit spending at a time when we have strong economic growth and low unemployment. Right. Exactly the opposite of what you would expect. And for me, the danger is this combination of lack of discipline fiscally, and then this monetary rectitude behavior, the Fed saying, we'll do whatever it takes to stamp out inflation.
Right.
All they're doing is putting up high borrowing costs for the private sector and enlarging the government's spending programs, their priorities, because Treasury will pay whatever it takes to get the needs to finance the deficit.